times under 60 milliseconds. This is a link from London to New York. These guys are approaching nature's speed limit, the speed of light, which would take about 40 milliseconds. About the only remaining way to go faster than they already do is to drill through the center of the Earth so that the cable would be shorter. Then it wouldn't have to follow the curvature of the Earth. A government report in the United Kingdom in late 2012 found that high-frequency trading could be beneficial by providing liquidity and what economists call rapid price discovery, meaning that if something happens that should affect prices, then it does, and very quickly at that. That's good. We don't want to be trading with someone who has private information that the current price is wrong, do we? We'd rather have the price adjust to fair value as fast as possible, even if slow minnows like us don't know just why it changed just yet. Most studies have found that high-speed trading, which means trades take place very fast, and its cousin, high-frequency trading, which means trading very often, lower the cost of trading for ordinary investors, including people like us. With high-frequency traders operating in the market, it's easy to find a buyer or a seller, and the price can't get too far out of line. These orders are only active for microseconds, a few millionths of a second. Such orders accounted for about 50 to 60% of U.S. equity trades and about 30% of equity trades in the UK at the time of the study. Some people think that high-frequency trading contributes to market volatility and is a tool for manipulating the market, and there's some evidence of this. We saw in Lecture 1 how computers can exploit tiny price differentials, for example. I don't particularly like being a slow minnow among sharks, but I take comfort in knowing that the sharks are all competing with each other for my business. That keeps me from getting hammered during the trading process. If shares in my company brought $100 when someone else sold a few minutes ago, then I'm not going to be too upset if high-tech trading firms want to fight over whether I get $99.99 or $100.01. I'm planning to hold my shares for a long time, and a few cents per share isn't going to keep me up nights. Spilling a glass of milk would cost me about as much. Every few months, we seem to see someone advance a proposal to limit high-frequency trading. The problem is that the proposals all pose difficult trade-offs. For example, some people want to impose a small tax on financial transactions like stock trades. The idea is that a fraction of a cent wouldn't be a big deal to people like us, but when multiplied over the vast number of trades that high-frequency traders make, it would be a significant deterrent. That might offer some benefits, but it might also reduce the speed at which prices adjust to news. The problem isn't as easy as it seems. We need to remember that I don't understand it, or I don't want you to play if I can't play too, doesn't necessarily mean the same thing as it's bad. In our next lecture, we'll explore the relationship between the risk of investing in stocks and the return we can expect to earn from owning them. We'll learn that stocks have had more than their share of ups and downs over the years. I'm not going to tell you that I know how to predict those ups and downs, but I can give you a better idea of what to expect. Just like anything else, when it comes to investing, the unknown is always scarier.